What if the next great Australian property boom isn't in Sydney or Brisbane, but in towns most Australians have never visited? The mining cycle is turning, commodity prices are climbing, and 10 specific Australian mining towns are positioned for explosive growth in 2026. Let's break them down. Number 1 will surprise you. Australian mining town property follows a brutal but predictable cycle. When commodity prices rise, jobs flood in, rental demand explodes, and house prices can double in 2 years. When prices fall, the same towns can lose half their value just as fast. Right now, in 2026, several forces are aligning. Global demand for critical minerals, lithium, copper, rare earths, is surging due to the energy transition. Iron ore demand is holding stronger than predicted. Gold is at near record prices. And Australia's geographic position as a stable, low-risk producer is more valuable than ever. These tailwinds are driving a new investment cycle in Australian mining regions, and the property markets that serve those mines are about to benefit. But timing and town selection are everything. Get this wrong and you lose. Get it right and the returns are extraordinary. Number 10. Mount Isa, Queensland. Yes, the same Mount Isa that featured in our Crashing Prices video, and that's exactly the point. Mount Isa has been hammered by the Glencore copper closure announcement. But here's the contrarian play. The lithium and critical minerals deposits in the surrounding region are attracting fresh investment, and several junior miners are at various stages of project development. If even one of these projects reaches production within the next 5 years, Mount Isa property could rebound sharply from current depressed levels. This is a deep contrarian play with substantial risk, but the entry prices are exceptional. Houses for under $300,000 in a town with infrastructure built for 30,000 people. Number 9. Kalgoorlie, Western Australia. The gold price has been at near record levels for over a year, and Kalgoorlie remains the heart of Australian gold mining. Median house prices have already started moving, but remain well below the previous boom peaks. With multiple producers expanding operations and gold likely to stay elevated due to global monetary conditions, Kalgoorlie has strong tailwinds. The town also has more economic diversification than most mining centres, with strong service sectors, tourism, and government presence. This makes it less brittle than single mine towns. Kalgoorlie is one of the few mining markets where you can buy with somewhat reduced risk. Number 8. Newman, Western Australia. Newman is the heart of BHP's Pilbara iron ore operations. Despite automation reducing local employment, total iron ore production from the surrounding region continues to grow, and BHP's long-term commitment to Newman is rock solid. Rental yields here can exceed 8% in tight markets. The risk is concentration. Newman lives or dies with iron ore prices. But if you believe iron ore demand stays robust through the 2030s, Newman is one of the most exposed property markets in Australia. Number 7. Cloncurry, Queensland. Cloncurry sits in the heart of Queensland's copper and base metals region, near major projects including the Ernest Henry Mine and various new exploration tenements. Copper demand is structurally rising due to electrification and renewable energy infrastructure. Cloncurry property is currently affordable but rental yields are strong. This is a leveraged play on the copper price. When copper runs, Cloncurry runs. Number 6. Roxby Downs, South Australia. Home to BHP's Olympic Dam, one of the largest copper uranium deposits in the world. BHP has announced major expansion plans for Olympic Dam that will require thousands of additional workers over the coming years. Roxby Downs is a planned mining town with reasonable infrastructure, and property here has been remarkably stable. The upcoming expansion phase should drive both rental demand and property prices significantly higher. Number 5. Moranbah, Queensland. Moranbah serves Queensland's Bowen Basin coal operations. Coking coal demand has remained surprisingly robust, supported by steel production in India and Southeast Asia. Several major coal operations near Moranbah have announced extensions and new projects. The town has the typical mining town volatility, but the current outlook supports a multi-year property cycle. Number 4. Karratha, Western Australia. Karratha is a critical hub for Pilbara iron ore, LNG operations at the Karratha gas plant, and emerging green hydrogen projects. The combination of established energy production, expanding LNG exports, and new renewable hydrogen investments makes Karratha one of the most diversified mining towns in Australia. Prices have softened from their peak, but the long-term outlook is strong if you can tolerate cycle volatility. Number 3. Tom Price, Western Australia. Tom Price is another core Pilbara iron ore town, home to Rio Tinto operations. The town has stable infrastructure, good services for a remote location, and rental demand that consistently outpaces supply when iron ore prices are healthy. Property is more affordable than Karratha, but with similar exposure to iron ore fundamentals. Number 2. Kambalda, Western Australia. Kambalda is at the heart of Australia's nickel and lithium operations. The lithium price has been volatile, but the long-term demand from electric vehicles and battery storage is structural. Several lithium projects in the Kambalda region are at various stages of development. If even half of these projects proceed, the demand for housing in the town will substantially exceed current supply. Property is currently affordable, and the upside is significant if the lithium thesis plays out. And number 1, the Australian mining town with the most explosive boom potential in 2026 and beyond. Port Hedland, Western Australia. Yes, the same Port Hedland we discussed as a major loser in earlier videos. The contrarian setup is extraordinary. Port Hedland is the largest iron ore export port in the world. Prices in the town collapsed by 60% or more from their boom peaks, meaning the market is starting from a deeply depressed base. Iron ore demand continues to surprise to the upside. New green hydrogen projects are being announced for the region. Workforce demand is rising even as automation increases per worker productivity. For investors who can stomach mining town volatility, Port Hedland offers an entry price that could prove historic. The risk is real. The potential reward may be the largest of any Australian property market today. If you're going to invest in any Australian mining town, internalize one rule. Buy when commodity prices have been depressed for at least 18 months and starting to recover. Sell when commodity prices have been at record highs for 12 months and rental yields have compressed to capital city levels. This counter-cyclical approach captures the largest gains and avoids the worst losses. Most investors do the opposite. They pile into mining towns at the peak when stories are everywhere, then panic sell at the bottom when nobody wants to talk about the sector. The cycle in mining towns is brutally consistent. Boom lasts roughly 5 years. Bust lasts roughly 5 years. The total cycle is typically 10 years. Investors who time it well make extraordinary returns. Investors who chase momentum lose their capital. This is one area of Australian property where contrarianism genuinely pays. A final critical principle for mining town investing. Never allocate more than 10 to 15% of your total property portfolio to mining town exposure. The volatility is simply too high to justify larger concentrations. Even if you have absolute conviction in a specific mining town's prospects, the cycles can extend longer than you expect, and the corrections can be deeper than seems possible. The investors who get destroyed in mining cycles, almost always those who concentrated their portfolios too heavily. Treat mining town property as your high-risk, high-reward sleeve within a broader portfolio that includes capital city growth properties and yield-focused regional assets. The combination produces a much better risk-adjusted outcome than concentration in any one strategy. Australian property rewards thoughtful diversification more than it rewards conviction. Always remember that. 10 Australian mining towns positioned for a potential boom in 2026 and beyond. The opportunity is real, but the volatility is brutal. These are not buy and hold suburban markets, they are leveraged plays on commodity cycles. Get the timing right, returns are exceptional. Get it wrong, the losses can be devastating. If you found this useful, smash subscribe. We break down Australian property data every few days. And if you want to see 10 Australian towns heading the opposite direction with prices crashing, click the video on screen. See you in the next one.